Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at ImmunityBio.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Right. So let's get right into it.
Yeah, imagine finding out that, the actual factory building a company's product is suddenly worth more than the blockbuster product itself.
It's a wild thought.
It really is. And that's the exact paradox we're unpacking today with ImmunityBio.
Yeah.
Because usually when you look at a clinical stage biotech transitioning into a commercial entity, the stock chart looks like an EKG of a patient in cardiac arrest.
Oh, absolutely. I mean, it's usually full of these massive, irrational spikes.
Terrifying drops, just a whole lot of unpredictability.
Exactly. Because the entire sector is built on binary outcomes.
Yeah.
Like a single FDA ruling can rocket evaluation into the stratosphere.
Yeah.
Or just, crater it to zero overnight.
Right. But when you look at your screen and pull up ImmunityBio right now, that volatile EKG has smoothed out. It's turned into this very steady, very aggressive climb up a mountain.
It's impressive to watch.
We're talking about a company that has executed a massive 325% year-to-date market cap increase. They're sitting at a $10.05 billion valuation right now.
Which represents a fundamental regime change for them. I mean, they've officially crossed the chasm.
Yeah.
They're no longer just this speculative lab with a great scientific theory. They're a commercial stage powerhouse generating real-world revenue.
Which really brings us to our core mission for this deep dive today. If you're managing your own portfolio and you see a 325% run-up, your immediate psychological response is probably, I missed the boat.
Right. The alarm bells go off. You think you're too late.
Exactly. So we're going to dive into the mechanics of this company to figure out whether this $10 billion valuation is just a fleeting, hype-driven spike where you are arriving too late,
Or if we're actually looking at the very beginning of a sustainable 12 to 18-month multi-catalyst growth runway.
Right. Because to answer that for you, the listener, we have to look past the ticker tape. We have to look directly at the underlying mechanics of the business.
Because at the end of the day, that valuation has to be supported by the cash register.
Well, let's open up that cash register then, because the 2025 revenue numbers are just explosive.
They really are.
We aren't talking about a modest earnings beat here. Their 2025 product revenue hit $113 million.
Wow.
Yeah, that is a staggering 700% year-over-year increase from the $14.75 million they did back in 2024.
And, a 700% jump, that's the kind of hyper-growth inflection point that forces Wall Street to entirely recalibrate their financial models.
Because it's real money. It's not an accounting trick, right?
No, not at all. It's entirely driven by their rapid penetration into the U.S. urology market with their flagship drug, ANKTIVA.
Okay.
Which was approved by the FDA in April 2024 for a very specific, stubborn type of bladder cancer.
But before we get into the whole sales strategy there, I think we need to unpack the actual science. Because the competitive moat here relies entirely on how this drug actually works.
Yes, the mechanism of action.
Yeah. ANKTIVA is an IP-protected, first-in-class IL-15 superagonist. And in the past, I know the industry relied heavily on older cytokines, specifically IL-2 therapies.
Yes, they did.
So why is IL-15 such a massive leap forward?
It's all about the collateral damage, really.
Okay.
Because those older IL-2 therapies, they do stimulate the immune system, sure, but they're incredibly blunt instruments.
Like a sledgehammer.
Exactly. They bind to receptors that can actually suppress immune function while simultaneously causing severe systemic toxicity. Things like vascular leak syndrome.
Oh, wow. That sounds awful.
Yeah, they end up damaging healthy tissue right alongside the cancer.
So using IL-2 is essentially like pulling the fire alarm in a crowded skyscraper. You wake everybody up, there's absolute chaos, the sprinkler systems go off, and you ruin half the building just trying to put out a fire in one single room.
That is a perfect way to visualize it. I mean, ANKTIVA, utilizing this IL-15 superagonist technology, avoids that fire alarm entirely.
How so?
Instead of waking up the whole building, it sends a direct, encrypted text message straight to the building's security guards.
I see.
And in the human body, those security guards are your natural killer cells, your NK cells, and your CD8 plus T cells.
Let's define those for the listener real quick. What exactly makes a natural killer cell so special?
Well, NK cells are your immune system's first responders.
Okay.
Unlike other immune cells that need to be, introduced to a specific cancer antigen before they know what to attack, NK cells inherently recognize distressed or cancerous cells and just destroy them on contact.
So ANKTIVA specifically wakes up these NK cells and the T cells to hunt down the cancer.
Exactly. And it completely spares the patient's healthy tissue from all the chaos of that systemic toxicity we talked about.
And this is where the business strategy gets really fascinating to me. ImmunityBio has this highly targeted weapon, but they aren't using it to wage a ground war against the pharmaceutical giants.
Right, they're being very smart about it.
Yeah, they're deliberately avoiding head-to-head battles with the absolute behemoths of oncology, like, Merck with Keytruda or Bristol Myers Squibb with Opdivo.
It's a masterclass in market positioning, honestly.
Yeah.
Because trying to unseat first-line checkpoint inhibitors like Keytruda, that would cost billions in marketing alone.
And you'd probably still lose, right?
Most likely, yeah.
Yeah.
Those drugs just completely dominate the initial treatment phase.
So instead, ImmunityBio positions ANKTIVA as a second-line rescue therapy.
Yeah.
They basically let Merck and Bristol Myers Squibb take the front line.
Exactly. Let them do the heavy lifting.
But when a patient's disease doesn't respond to those checkpoint inhibitors, or if the cancer comes back, that standard frontline army has officially failed.
Right.
And ImmunityBio acts as the special forces team that gets called in when all other options are exhausted.
And by doing that, they're co-opting the market share rather than cannibalizing it. They've identified this massive, underserved, addressable market of desperate patients who've already failed those first-line therapies.
And the global expansion of this strategy is moving aggressively, too. They already have commercial partnerships in 33 countries.
Which is huge.
Yeah, which leads to a massive catalyst on the horizon. In February 2026, they are staring down an EU conditional approval that is going to open up 27 new nations all at once.
That's a massive influx of potential patients.
It is. But hold on, let me push back on this entire growth narrative for a second here.
Sure, go ahead.
Whenever I see a 700% revenue spike in a single year, my immediate thought is low-hanging fruit.
How do you mean?
Well, you have a pent-up demand of desperate second-line patients who have been waiting years for a new option, right?
Right.
The FDA grants approval, the floodgates open, those patients get treated, and boom, revenue spikes 700%. But what happens on day 2?
I see what you're saying.
Yeah, aren't we staring down the barrel of a massive plateau now that the initial wave of desperate patients has been cleared out?
That is the exact bear thesis that skeptical institutional investors are modeling out right now.
It makes sense logically.
It does, but the fundamental flaw in that worry is assuming patient demand is the actual bottleneck.
It's not.
No, because the demand is structurally built in. Unfortunately, a very predictable percentage of patients will continuously fail those frontline therapies year after year.
Oh, right, because new patients are always entering the system and failing the frontline drugs.
Exactly. The real bottleneck, the actual ceiling on their growth, is supply. It's manufacturing scale and unit margins.
So the challenge isn't finding people who need the drug, it's physically making this complex drug fast enough and cheap enough to treat them all.
Bingo.
Which brings us to the manufacturing moat. We mentioned a $10 billion valuation earlier. In the cell therapy space, your manufacturing infrastructure is basically your product, isn't it?
Without it, your science is just, an expensive science project.
Yeah. Right.
But ImmunityBio has built a fully vertically integrated manufacturing model. They're operating over 1 million square feet of facilities across California and New York.
That is massive.
It is. They control the entire life cycle, from the initial R&D all the way through to large-scale biologics production.
For context for the listener, most biotech companies have to outsource this to third-party manufacturers, and the margin leakage there is just brutal.
Oh, absolutely brutal.
You are giving away 30 to 40% of your potential profits just to get the drug physically made. So by bringing it all in-house, ImmunityBio retains absolute control over their supply chain and their profits.
True. But that level of infrastructure requires staggering capital.
Which is exactly where I want to do a financial reality check. Because saying we built 1 million square feet of advanced manufacturing is really just an incredibly polite way of saying we are burning through a mountain of cash.
It certainly is.
Let's look at the actual numbers.
Well,
for 2025, they posted a net loss of negative $351.40 million. That translates to an earnings per share of negative 38 cents. But more concerning for anyone holding the stock, They are running a negative $213 million free cash flow.
It's a big number.
That is a massive hole. Are they building a moat here, or are they just digging a grave?
On the surface, yeah, a negative $213 million free cash flow is alarming. But you really have to look at the trajectory, not just the absolute number.
Okay, unpack that.
Despite the 700% revenue growth we just talked about, that massive net loss actually improved by 15.03% year over year.
Oh, okay. Break down why that specific metric matters so much to an investor.
It proves that operating leverage is finally taking hold.
Right.
In a poorly managed biotech company, if revenue scales up 700%, the variable costs required to produce that revenue often scale right alongside it. So the net loss actually widens as they grow.
But ImmunityBio's loss shrank by 15% while their revenue exploded.
Exactly. That proves their vertically integrated factory is actually working. Every subsequent batch of the drug they produce is getting cheaper and cheaper to make.
And that brings us to the major catalyst from March 13th, 2026, which really seems to be the holy grail for this company's margin.
Yes, the engineering programs.
Right. They announced the successful completion of their NK 2022 and NK 2023 engineering programs. And the headline number is absolutely wild. They've proven they can now produce 5 billion NK cells per apheresis and successfully cryopreserve them.
We really need to unpack those terms, apheresis and cryopreservation, because while they sound incredibly dense, they are the skeleton key to unlocking this entire $10 billion valuation.
Okay, let's start with apheresis. What exactly is that process?
Historically, cell therapies were entirely custom-made.
Right.
You draw a specific patient's blood, run it through a machine to separate out the components, that's the apheresis part, isolate the cells you need, engineer them in a lab, and then infuse them back into that one specific patient.
It's like being a high-end bespoke tailor. Every single suit has to be individually measured, cut, and hand-sewn for one specific person. You can charge a huge premium, but you can only make a few suits a month. It's brutally slow, it doesn't scale, and the costs are just astronomical.
Yeah, and what ImmunityBio just achieved with this 5 billion cell milestone is the equivalent of that bespoke tailor inventing a proprietary machine that can perfectly mass produce thousands of custom suits from a single spool of fabric.
Wow.
And the second part of that announcement, the cryopreservation, means they can freeze those perfectly engineered cells in time without damaging them at all.
So they achieve true off-the-shelf cell therapy. Like a hospital in Germany or Japan can just pull a vial out of a specialized sub-zero freezer and treat a patient immediately.
Exactly.
They don't have to wait weeks for a custom batch to be engineered in California while the patient's cancer is spreading.
And it completely rewrites the unit economics of the entire business.
Look, the technological breakthrough is undeniably brilliant, I'll give you that. But I have to press you on the cash burn again.
Fair enough.
A negative $213 million free cash flow is still a ticking clock. Are retail investors just going to be diluted to death with secondary stock offerings just to keep the factory lights on while they wait for this mass production facility to turn an actual profit?
It is a calculated risk, absolutely. It always is in biotech. But Wall Street is looking at that cash burn and concluding that the heavy lifting, the massive capital expenditure of building the bioreactors and cracking the mass production code is now largely in the rearview mirror.
Interesting.
And we know this is the institutional consensus because of how the stock is actively trading right now.
Well, let's pivot and look at that technical momentum then, because when a company cracks the code on cell therapy mass production, the algorithms definitely notice.
They do.
The charts are telling a very specific story about sentiment right now. As of March 17, the stock is trading in an intraday range of $8.83 to $9.80. But you have to look at where that sits relative to its moving averages. The stock is sitting well above its 50-day moving average, which is at $5.98.
Right.
And it is massively above its 200-day moving average, which is way down at $3.38.
Yeah, and when a stock breaks that far above its 200-day moving average, it confirms a definitive breakout from a multi-month consolidation phase.
So it's not just noise.
Exactly. Institutional algorithmic models interpret that gap, not as a temporary retail pump, but as a fundamental regime change in the company's valuation.
And the volume absolutely backs that up. We're seeing highly elevated volume, recently hitting 30.4 million shares traded. But the critical detail hidden in that volume is that there are zero signs of distribution.
We should probably clarify what distribution means for the listener here.
Yeah, please do.
Distribution happens when the large institutional players, the Wall Street whales, start quietly selling off their massive positions into retail buying pressure to lock in their profits.
Right.
You usually see this manifest as high-volume down days on the chart.
Because human nature dictates that if a stock runs up 325%, the funds who bought in at a $3.38 average are going to take their profits and run.
But they aren't.
Exactly.
The absence of distribution means those institutional whales who bought at $3 are holding tight at $9 or $10. In fact, many are actually adding to their positions.
Wow.
Their trading behaviors suggest they believe a $10 billion market cap is actually cheap.
And the analysts are publicly putting their reputations on that exact same thesis. Just a few days ago, on March 12, BTI initiated coverage on ImmunityBio with a buy rating and a $13 price target.
That's a strong signal.
It really is. That signals a 36% upside from where we are sitting right now. Furthermore, their relative strength index, the RSI, is sitting at 57.52.
And an RSI 50 say is perfectly balanced. It's neither overbought nor oversold.
Right.
It indicates the stock has significant room to run without being technically overextended and vulnerable to a violent pullback.
Plus, they just released phase I data for a new combination therapy, MCENK plus ANKTIVA. It showed excellent safety profiles in 74 enrolled subjects, which just throws more fuel onto the bullish sentiment fire.
Yeah, it's just more good news.
But I'm going to play devil's advocate for the listener here.
Go for it.
The stock is already up 325% this year alone. If you're listening to this right now and you buy in at $10, aren't you just arriving late to the party? Aren't you just stepping up to hold the heavy bags for the institutions who secured that $3 average price months ago?
That fear is the most common psychological trap in investing. Assuming that just because a stock has made a historic move, the move is entirely over.
It's hard not to feel that way, though.
Of course. But if you look at the company's timeline, the current valuation isn't just a reward for what happened in the last 3 months. It's a forward-looking premium based on the fact that the most lucrative wealth-building events are heavily stacked in the next 90 days.
Okay, let's lay out that 3-month catalyst calendar then, because the sheer density of binary events coming up is intense.
It's packed.
First up, we have the March 9 resubmission of the FDA Supplemental Biologics License application. This is their SBLA for papillary disease. We are expecting a final decision on that in Q2, somewhere between April and May.
And for those unfamiliar, an SBLA is essentially asking the FDA for permission to market an already approved drug to a brand new group of patients.
Right.
And the financial impact of this specific decision is massive. Papillary disease represents a larger market segment than what NTTs are currently approved for.
It's a massive label expansion. I mean, if approved, it increases their total addressable market by 30 to 50% overnight. And models suggest it could instantly add $50 million or more in incremental revenue. And right on the heels of that, in late Q2, they're filing with the FDA for glioblastoma.
And glioblastoma is a notoriously aggressive and difficult to treat brain cancer.
Yeah, it is.
If ImmunityBio can prove their IL-15 platform works across the blood-brain barrier just as well as it works in the bladder, it completely re-rates the foundational value of their entire scientific platform.
Then, as we move into Q2 and Q3, we have the potential RBCG approval, either in the U.S. or Saudi Arabia. This is happening via their partnership with the Serum Institute of India.
This is such an interesting angle.
It really is. You have to understand the historical context here to see why this is so brilliant. For decades, a specific strain of bacteria called BCG, which is actually an old tuberculosis vaccine, has been the gold standard of care for early-stage bladder cancer.
Right.
But there has been a massive worldwide shortage of it for years.
The global supply chains for BCG just completely failed.
Yeah.
So by partnering with the Serum Institute, which is the world's largest vaccine manufacturer, ImmunityBio isn't just trying to sell their advanced drug. They're stepping in to produce recombinant BCG, or RBCG.
Which solves the foundational supply chain crisis for the standard of care.
Exactly. It positions them as the comprehensive savior of the entire bladder cancer market while generating a highly lucrative, entirely new partnership revenue stream.
And amidst all of these clinical and regulatory events, in late April, we are getting their Q1 2026 earnings report.
The moment of truth.
That is the moment of truth. It will give us the vital revenue guidance for the year and show us exactly what the commercial uptake of ANKTIVA looks like now that their manufacturing engine is really humming.
But, to manage a portfolio responsibly, you must remain objective and look at the hidden risks. Biotech is never a guaranteed path to wealth, no matter how good the science is.
That's very true. We have to talk about the scars this company carries.
We do.
In 2023, ImmunityBio received a complete response letter, a CRL, from the FDA. The FDA effectively rejected their application, specifically citing deficiencies in their manufacturing processes, and the stock got absolutely hammered.
Which underscores why manufacturing scale-up is always the paramount risk.
Yeah.
Yes, they just proved they can hit 5 billion cells per apheresis in an isolated engineering run.
Right.
But executing that flawlessly at a global commercial scale month after month with zero contamination is operationally brutal.
It's so hard to do.
Any facility disruption, any quality control slip that catches the FDA's attention, and that 700% revenue growth grinds to a sudden halt.
Given that history of regulatory rejection, is the market being naive right now? Are investors underpricing the risk that the FDA might look at their papillary disease expansion in May and just hand them another rejection letter?
It's a very real threat, and regulatory setbacks are just a constant shadow in this space. However, the market is pricing in a higher probability of success this time because of the track record since that CRL.
Okay.
They received that rejection in 2023, but they successfully remediated every single issue the FDA flagged and won full approval in April 2024.
So they've already survived the gauntlet.
Exactly. They learned the FDA's incredibly stringent playbook for cell therapies the hard way.
You also have the eventual risk of pricing pressures. As ANKTIVA gets more popular and expands its label, insurance companies and payers are going to start squeezing them on reimbursement rates to protect their own margins.
True, but this ties back to their genius market positioning. Because they are a second-line rescue therapy, they have incredible pricing power.
Oh, because there are no other options.
Exactly. They aren't fighting a race to the bottom price war against generic first-line checkpoint inhibitors. They're offering a literal lifeline to patients who have completely exhausted all other options. Payers have very little leverage to deny reimbursement in life-or-death second-line scenarios.
Let's pull all of these threads together for the final synthesis. When you look at the totality of the data, the 700% revenue explosion, the massive manufacturing breakthroughs with cryopreservation, the lack of institutional distribution on the charts, and a densely packed 90-day catalyst calendar, we are scoring the ImmunityBio investment thesis an 8.5 out of 10.
Yeah, it presents a highly asymmetric risk-reward profile. This specific setup is built for growth-oriented investors who understand the timeline and can stomach the inherent volatility of the biotech sector.
It is perfectly positioned as a 12 to 18-month multi-catalyst trade. You have near-term regulatory events providing tactical entry points and a structurally sound path to outright profitability within the next 2 to 3 years.
As that operating leverage finally overtakes the cash burn.
Exactly.
They've successfully de-risked the two hardest parts of the biotech business: getting a complex drug approved by the FDA and figuring out how to mass produce it. Moving forward, it is entirely a game of execution and global scale.
Which leaves you with one final concept to mull over regarding your portfolio. We started this deep dive talking about the unpredictability of clinical science, but think about what ImmunityBio has actually built in the background.
It's incredible to think about.
If they have truly cracked the code on how to seamlessly manufacture, scale, and cryopreserve 5 billion NK cells per apheresis, ask yourself a much bigger question.
Right.
Down the road, could their proprietary manufacturing infrastructure, that 1 million square feet of perfectly tuned mass production capability, eventually become just as valuable, if not more valuable, than the actual cancer-fighting drugs they sell today?
In an industry that is absolutely starved for scalable, high-quality cell therapy supply, owning the factory might be the ultimate untouchable moat.
Something to think about as we watch these next 90 days unfold. Thank you for joining us on Smart Wealth with Joshua. Don't forget to subscribe, like, and leave a comment to support your wealth building journey. We will see you next time.